Google locks in star power with a Fusion PPA. What does that mean for you? BlackRock is ditching long bonds for short-term safety. Is it time to rethink your strategy? Powell blames tariffs and gets a standing ovation from his peers. What's the real impact? Banks cruise through a softer stress test. Are they stronger than we thought? And we break down dividends versus buybacks. What's the better play for your portfolio? Watch to the end to find out which move could boost or break your investments this week.
Hi, Deep Thinkers. I'm Gary Broad from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Farian. He's the CEO and founder of Flying V, our digital marketing partner. Rob, what's going on? How was your 4th of July? And more importantly, how was your Independence Day? Let's call it by its proper name.
There we go. Yeah, it was great, Gary. I think it's set up for the perfect 4th of July American weekend, right? With the 4th falling on a Friday. So, I was out at the beach, the water, fireworks show, flybys, the whole 9 yards. They had it out in spades here in Southern California. So that was really nice. How was yours? I know you're abroad, so a little bit different, but hopefully you got a few minutes to celebrate. I don't know if you're able to find a hot dog over there, but hopefully you had a few minutes.
Yeah, so I don't know that there were a whole lot of Independence Day celebrations here in Portugal, but I did have an interesting weekend. I went to a small town, a walled town called Evora. It's been there for thousands of years. It was at one point a Roman fortress, and there is a cathedral in there made out of human bones. And just to walk into this room that literally it's all constructed out of human remains is powerful reminder that we all have only so long here on this planet. And it was kind of a spooky experience, but, well worth a visit.
Great. Yeah. And this week, really excited to obviously get back into the fold. Feel like 4th of July kind of marks that first 6-month sprint of the year. Let's finish strong for the final 6 months. This week, with this week's version of the 5 things, we're calling it the Fusion issue. So as always, we're going to keep you on top of everything you need to know in the market, what's happening, important points to know, what to do with your portfolio, and how to position yourself for success. In this week's episode, we're talking Google, their Fusion Energy play. BlackRock makes an appearance. We've got the battle with President Trump and Jerome Powell really starting to boil, or maybe starting to come to a crescendo as well. We're talking banks, and then finally we'll get into our 5th and final thing, our educational topic, where we talk about dividends and stock buybacks and how we make money. Gary, before we get into it, anything else from you before we talk about the fusion issue?
No, let's dive in and talk about nuclear fusion.
Awesome. Gary, let's get right into it with this week's version, the fusion issue. The main topic, we're talking about Google, and they have an agreement to buy Fusion Energy. You note in the written version of the 5 things, doesn't change much for us in terms of how we think about uranium. Gary, thing number 1, Google's landmark Fusion Energy deal. Tell us what we need to know.
So, Rob, the key thing here is this is a deal to purchase potential power. And the reason we need to add that clarifier is, as of now, there is no commercially viable option for fusion energy. Right now, the only real use of fusion on this planet so far has been in nuclear weapons. They are more powerful than the original fission bombs that were actually used during World War II. And, the nuclear plants that we're all used to seeing, the big one, like, we all saw in The Simpsons with the big cooling tower like that, those are fission reactors. That technology has been made very safe. We've talked about the Gen 4 reactors many times on the show, and I think it's going to be the future of energy for the United States and for the world. What Google has done is they've made an agreement with Commonwealth Fusion to purchase 200 megawatts of electricity from a future fusion power plant. So again, this technology is not commercially viable today. I have been following the this kind of power and cold fusion and things like that for decades. And there are people who are saying that this could be viable, a non-explosive power source within the next 5 to 10 years. There are other people who are saying, maybe we're 30 years away. Now, I don't know. I don't know that anybody really has an answer on that. But the key thing is this power source is about 4 times more efficient than current uranium uh, fission reactors. And so that itself is just a completely, it's an order of magnitude greater than the coal and natural gas and oil that we've typically been using for energy. So the potential here is enormous. It's just not something that's available yet. But Commonwealth Fusion does think that this is something they could have working sometime early to mid next decade. So it's not really that far away. I'm going to read something. I'm going to credit the interns on this one. This is phenomenal writing here. From the written version, creating a controlled, sustainable fusion reaction is difficult. Scientists claim it's essentially like making a star on Earth, requiring light atoms to be heated to over 100 million degrees Celsius so they can fuse into heavier atoms, which release energy. For those of you in the United States watching this, Celsius is just scientific speak. Don't worry. I have not gone over and become European. We still use Fahrenheit at Deep Knowledge Investing, but either way, 100 million degrees, no matter how you're counting it, is a big number.
Yeah, that seems like a lot, no matter what the conversion rate might be. Gary, with these fusion reactors, I'm curious on a couple things. One, what fuel do they use? And then two, I know DKI obviously heavily bullish on uranium, have positions in the uranium market. I mean, does that impact that at all? Sounds like it's going to be a little bit more long term, but also 5 to 10 years is not a long time, and that happens fast.
Yeah, that's a good question, Rob. So here's the thing. The fusion reactors do not use uranium, which is used for the fission reactors, which is what we have now. The fusion reactors use a hydrogen isotope or different hydrogen isotopes as fuel. So that is different. But here's the thing. Google's predicting 5 to 10 years. Other researchers are saying 30 years for fusion. And remember something, even if it is 5 to 10 years, that doesn't mean that all of a sudden we get to 5, 10 years out and that infrastructure just exists. It will take decades to build out commercially viable fusion reactors. In the meantime, we expect there to be a severe shortage of uranium in the next 2 to 3 years. So no matter what happens with fusion, we are looking at a situation where there's going to be a uranium supply crunch, just a lack of supply. And by the way, there's been an imbalance between supply and demand in uranium for years, but by our estimates, we think there's maybe 2 years of excess supply left. So the point of all this is we are definitely cheering for fusion to work. It's good for the human race. It's a phenomenal energy source. Great if we can do it with hydrogen isotopes. But even if it comes sooner rather than later, it's not going to come soon enough to prevent a shortage of uranium. We are still hugely long and very bullish on uranium.
Great stuff. Sounds like a win-win there, Gary. And we'll obviously keep you in tune with developments with Google's new reactor, or not reactor. What would be the right term for these, Gary? Reactor?
A new, well, it would be a reactor, but a new commercial energy source. It would be a fusion energy, which would come from a reactor, but it would be unlike any energy source being used today, or rather, let me rephrase that, any controlled energy source being safely used today.
Right. Great stuff. Moving forward, Gary, we're going to talk about BlackRock now. They've shortened the duration on its Treasury portfolio. We've had Jerome Powell, and as we've documented multiple times on this show, Jerome Powell claiming he doesn't have confidence in Fed projections. Obviously, extremely hard to blame anyone with not having confidence in Jerome Powell's projections, as we've highlighted, as I mentioned. Thing number two, Gary, BlackRock bets on the short term.
Yeah, that one made me laugh, Rob. So what's happening with BlackRock is they're shortening the duration on their Treasury portfolio. Just a fancy way of saying instead of buying more 10-year bonds or 20-year bonds, they're buying more 2-year bonds, right? And that's it. They're just going shorter on what they're purchasing. Now, the thing that I think is really interesting on that is, and Cashin Crow, DKI star intern from the University of Tennessee, did a great graph on this for the written version. And what he showed was that a year ago, the yield curve was inverted. Okay, just a fancy way of saying that you got paid more for short-term bonds, a higher interest rate, than you were getting paid for long-term bonds. Now, the yield curve wasn't entirely inverted, but most of it was. Now, this year, we actually have a mostly normal and much flatter yield curve, which, again, just a fancy way of saying that if you want to go out to 10 years, you'll get paid more than you would if you were buying 2-year bonds. And so what's really interesting about this is BlackRock is saying last year, they were buying more long-term bonds when the yield there was lower and fewer short-term bonds relative to where they are this year when the yield was higher. Now that that's reversed, they're actually buying more of the 2 years and fewer of the 10 years. So the yield curve has gone more normal, but they're still shortening their duration. Now, obviously, part of it is exactly what you just said. There's a lot of uncertainty, and if you're buying bonds going out, that won't be paid for 10 years, then you're taking a lot of duration risk. You don't know what's going to happen over the next 10 years, and you're trying to project over a longer, more uncertain time period. And as you pointed out in his last press conference, even Fed Chair Jerome Powell said, we don't have a lot of confidence in our projections. And, in fairness, let's give the chairman credit for saying the truth in public. I don't have confidence in the Fed's projections either. So good for him for acknowledging it, but that's what's going on with BlackRock.
Gary, in terms of BlackRock and their conclusion, I mean, do you agree? Do you disagree with their conclusion? And then in regards to you, I mean, what would you do in this particular situation?
So 2 sets of questions there, Rob. Let's take those in order. First, I can't believe I'm going to say this. Like, I typically disagree with BlackRock. I've been not a fan of them for many, many years. I think they're making the right call on this one. Again, one of the reasons the yield on the 10 years come down is investors are pricing in an expected reduction in the Fed funds rate. When that happens, and it will happen at some point, I don't know that you're necessarily going to get lower long-term rates. I think the market will price in higher long-term inflation. In addition to that, one of the things that we were saying, and Rob, you remember this last summer and all last year, is there are lots of reasons to go vote in last November's election, but lower government spending isn't one of them. We said that no matter who won the election, whether it was Team Red or Team Blue or some combination, that Congress is going to spend more and more and more. That is exactly where we are right now. What happens with that is the only way we can afford to spend more is to take on more debt. That involves an increase in the money supply, and that leads to inflation. So when that happens, we're going to be looking at higher long-term yields, plus the economic uncertainty. That's what's pushing investors into lower duration bonds. I actually think BlackRock is thinking about this the right way. If I were them, I'd be doing the same thing, except I wouldn't be buying government bonds. So you were asking the question, what is DKI like? And here's the thing. People think about government bonds as being safe. And I think that's a misnomer. It's safe to the extent that the government will pay you back, right? If you lend the government $1,000 for 2 years, in 2 years, they'll pay you back. And there's no risk that the government won't be able to print the currency and hand you, $1,000 of fiat currency. I don't think government bonds are safe simply because who knows what the purchasing power of that is going to be. They'll give you your $1,000 back, but what will you be able to buy with it? And inflation runs, as we've talked about many times on the show, well above what the CPI is, what people think inflation is. Anybody who's gone to the grocery store knows we're not at 2% inflation. Anybody who's tried to buy, a car or a house in the last few years, right? We're not at 2% inflation. That's kind of ridiculous. So, basically what I prefer are uncorrelated assets like gold and Bitcoin versus treasuries. Now, some people will say, well, wait a minute, I like the predictable return of government bonds. And If you are a senior on fixed income, yeah, I get it, right? Gold and Bitcoin, sure, that's a very uncertain return. You could lose money in them. If you need that money to live on, of course, you need something where you have predictable cash flows like treasuries. But if you have a little more time and a little more risk tolerance, my response is I would much rather own gold and Bitcoin, much more Bitcoin than gold. And so the question that we're asking is, would you prefer to lose money slowly in government bonds or make money inconsistently in things like Bitcoin and gold? And that's where I am. I'd rather make money inconsistently.
Yeah, I think it's been pretty obvious where we sit on this topic. Inflation too, you just in general conversations, right? It's just funny the way you think about things. $1,000, $10,000, even $100,000 in certain conversations, and like just the buying power. Like you can feel the difference in every single conversation you have. And if you're a loyal follower of DKI or a new follower, you know that inflation is going to continue to run rampant, or at least that's our position. And we've set up portfolio positions for DKI specifically for that, which leads me to, we'd love if you could head over to our website, deepknowledgeinvesting.com. Grab a free subscription. That'll get you signed up for our newsletter. You could also consider a premium subscription and access to all gated content material, webinars, current recommendations, buys, sells that are being made in the market by Gary. Moving on to thing number 3, Gary, we're talking President Trump versus Jerome Powell. President Trump sent a nice little note over to Jerome Powell. Not sure if you picked that up on social media, but Powell blamed President Trump actually in front of a bunch of central bankers in Europe. The European central bankers, though, do support Trump-like policies back at home. You noted, Gary, thank you for your attention to this matter. Pretty much becoming Trump's famous sign-off, it seems. Gary, thing number 3, Powell discusses UF tariffs at ECB forum. Really excited to hear what you have to say about this one.
Yeah, so we're gonna have it's so funny, Rob. You're actually saying I'm so excited to hear what happened at this European Central Bankers Forum, right? It's here we are at DKI. It's pretty dorky if we're so excited about a central bankers forum. I know. Here we go.
It's a story that just keeps. You can't make this stuff up.
Yeah, it is. These people are absolutely hilarious. First of all, this forum took place last week in Sintra, Portugal, which, believe it or not, is less than an hour from where I'm sitting here in Lisbon right now. A few weeks ago, I actually took an Uber there. It was unbelievably cheap. I think my Uber was like, I don't know, $20, $25, in dollars. It was a little less in euros. And Sintra is this beautiful old town, really hilly and mountainous, and they have like this, the remains of a 1,000-year-old Moorish castle there, but all kinds of other castles and cathedrals there. And I spent an exhausting day walking up and down these literally mountains, and seeing these old places, and it was pretty amazing. So for anybody who's interested in this, I highly recommend Sintra for a great day trip out of Lisbon. Anyway, so the European Central Bank had their forum there. Federal Reserve Chairman Jerome Powell appeared, and in his "screw you, President Trump" response to President Trump's post on social media calling Chairman Powell an idiot, or I don't remember his exact language, but at this point, it's pretty obvious these two do not like each other. Chairman Powell blamed President Trump's tariffs and the uncertainty caused by them for the reason he hasn't reduced interest rates in the United States. I think his exact wording was they delayed rate cuts when we saw the size of the tariffs, and essentially all inflation forecasts for the United States went up materially as a consequence. Okay, great. So he's basically saying the reason you don't get the interest rates you want is because of President Trump and, all of this. So when he did this, he got a standing ovation from or applause, whatever, from his international counterparts, including ECB President Christine Lagarde, who we insist is not a vampire. So we just want to be clear. We have no direct evidence that Christine Lagarde is a vampire. Please stop saying that.
This is where the suppression comes from.
That's That's
the
exactly
suppression
it.
of our channel. Jerome is definitely Jerome, Christine. Who else are we lining up?
Right. No, but listen, I'm being positive. Please, nobody say that Christine Lagarde is a vampire. We do not have any documented evidence of that. Bank of England Governor Andrew Bailey was in the crowd. Okay, so they're all applauding.
Mm-hmm.
But in the meantime, right, those same countries have had huge tariffs on U.S. goods. And so I find it kind of curious that these top bankers and economists believe that U.S. tariffs are going to create inflation and slow economic growth and create all kinds of economic calamity. But somehow in their own countries, they manage with these same supposedly inflation causing growth, killing restrictions in their own countries. The only thing I can come up with, Rob, is that these bankers like President Trump's policies, they just don't like him personally, and that's making its way into policy. So here we are. Either that or they just like having protectionist regimes at home, but they want unlimited, unrestricted access to the US's giant consumer market. And my response to them is drop your own barriers.
Right.
If you want free trade, then be a free trader.
Right. Gary, yeah, I laugh about all this because it's just like almost a movie or a sitcom at this point, right? But I mean, seriously, how much of this is just optics? I think at there's no way that Powell or Trump or whichever side of the aisle, there's obvious political motivations. They look like political actors, especially on the Fed side, which is supposed to be this non-biased party. I mean, how do they get out of this? Are they going to look bad no matter what? And then how much of this is just a bunch of show?
Well, listen, Rob, anytime you have political actors, and anybody who thinks central bankers are not political actors is not paying attention. Yeah, I know. If you want to put in the comments that the Fed is supposedly an independent institution, feel free to put it in the comments. Like, go ahead. But the fact is, central bankers are political actors. There's no question about that. Regardless of what the charter says, they aren't supposed to be. Let's take this apart going from east to west. The European central bankers certainly despise President Trump, and they love, running up the score and saying, look, we're the good guys, President Trump's the bad guy. They love that kind of posturing. But the fact is that they have the same kind of Trumpian policies in their own countries, and they never complain about that. Basically, what I think on their end of things is they like the idea of having the benefits of protection on their end and the benefits of free markets on our end. That works to their selfish self-interest. And by the way, it's okay. Everybody's entitled to have their own selfish self-interest, but guess what? So is the United States, right? And when President Trump acts to protect the selfish self-interests of the United States, the rest of the world should not be surprised because they're doing the exact same thing. My only objection is the obvious hypocrisy of them advocating against policies here that they engage in there. And the fact is, it's all appearance. The only reason they get away with it is because you can always win points, trying to score on President Trump if you're in Europe. Okay, that's where we are. Now, on the Federal Reserve side, Rob, when the Fed lowered rates starting last September, I said they made a huge error. And we put this in writing. We talked about it in this show. What I said at the time was, one, they're too early. They don't have inflation under control. That's still the case. At this point, we are 10 months later, and inflation is still above the 2% target, which itself is still 2% too high. They do not have this under control. It's gotten better, but it's not under control. More importantly, at the time, I said Powell has now made it clear that the Fed is willing to appear partisan, regardless of what his motivations were. When they lowered rates just 2 months ahead of the presidential election, the Fed appeared to be trying to help the incumbent, in this case, the Democratic Party, hold on to the White House. And given the unbelievable animosity between Chairman Powell and President Trump, it's pretty easy to come to the conclusion that Powell wanted to see the Democrats win the election, wanted to keep President Trump from returning to the White House. And it appears that he did what he could to try to stop that and try to put his thumb on the scale for the Democrats. It was too late, didn't work. And now he's really stuck, because if he lowers rates, it will look like he's bending under President Trump's unbelievable public pressure. And if he doesn't, it will look like he is going to try to harm the economy simply as a way of telling President Trump, go blank yourself. And so I think no matter what he does at this point is going to look political. And by the way, this brings me to a point that I've made before. President Trump is not blameless in all of this.
Sure.
I have said before that his public campaign against Chairman Powell is a mistake. And the reason it's a mistake is because now for Chairman Powell to give President Trump what he wants, it has to look like Chairman Powell is caving under the pressure. Had President Trump applied pressure quietly and in private and not done so in public, Powell would have the option to lower rates and not look like he was caving. In general, I think President Trump is very strategic in who he chooses as his targets in this particular situation. I think all parties have acted in a way where nobody has room to maneuver and still save face. Now, as an American citizen, I don't care if these guys save face or not. Do what you can to fix the economy, right? But human beings are human beings, and we need to understand that they will act in their own self-interest, even if it may not be in the best self-interest of the country.
Gary, just real quick, what's Powell going to do with the next decision?
I think they're gonna stand pat. The employment number we got last week, and I've been saying for years, the employment data is not reliable. As a result, there's just not a whole lot that can be done about it. But basically, I think the Fed looks at two things. They look at inflation, whether it's the CPI, the PPI, the PCE, and those numbers they've come down a lot. It's gotten better. They're pretty stable, but above target. They're sort of in that range where the Fed could think about lowering, but maybe shouldn't yet. And it looked like they were going to. It looked like they were about to lower rates. And then last week we got a really strong employment report. Let me rephrase that. It wasn't so much a really strong employment report. It was a good employment report that was stronger than expected. It came in a few tens of thousands of jobs better than what was expected. And I think I saw the revisions. They revised the historical numbers up as well. Basically, what that's saying is that the employment data is strong enough that I think the Fed is going to hold on, at least through the next meeting and not do anything.
Gotcha. We'll keep you in tune with those decisions as they get made on the 5 things. That's what you're watching, this week's version of the 5 things, the fusion issue. Moving forward, we're talking about major banks. They had a stress test that they didn't pass, that include increased capital return to shareholders. They passed these tests in 2008 as well. Gary, not to ruin maybe your punchline, but thing number 4, I probably did. Major banks passed the Fed stress test. Does it matter? And Gary, with that, knowing what happened in 2008, how can we put any trust in this type of stuff?
So, Rob, I'm just going to give you a warning. Next time you do that, we're switching seats and I'm going to interview you. You're going to have to explain this stuff to the audience and I'll get to ask the questions.
Giving me too many answers here. And we started this show about an hour earlier today. So maybe it was that lack of morning coffee that I had on the West Coast.
Now I know what to do, Rob. I'm going to stop sending you an advanced version of the written edition of the 5 things, right? Yep, you're going to have to do this live. All right. So major U.S. banks face the Federal Reserve's 2025 stress test. That sounds stressful, difficult, right? And those tests, they check to see whether the banks have sufficient capital to withstand a severe economic recession. Well, we have sort of good news. All 22 banks remained above the required capital ratios. Everybody passed. A's for everybody, right? Let's have recess outside. Here we go.
Yeah, it's very interesting how that works.
Yes. Immediately, all of the big banks did exactly what we would have expected them to do. They increased their dividends. They increased their stock buybacks. Okay, that's fine. However, there are a couple of things that jump out. One, the test this year was less intense than last year's. I find that kind of surprising. Now, remember, just a week or two ago, we were talking about the fact that banks are increasing their loan loss reserves because consumer credit has been weakening, right? we have more people under financial stress. So if the banks are increasing their loan loss reserves because of weakening consumer credit, why in the world is the stress test easier, right? That strikes me as kind of nutty. The next thing is, this is really important. The scenarios that they outline for the banks to pass these tests are hypothetical, because of course they are, right? But once you get into the real world, when things get out to the tail end of crazy and nutty and difficult, right? Things never play out like they did in the stress test. And so, before 2008, banks passed similar tests. That was the thing you were pointing out, right? Well, so banks passed the hypothetical test in 2008, but when the real test came, they crumbled. Banks went under. You had Lehman going under. You had Bear Stearns collapsing and being bought for, I think it was $2 a share. And a bunch of the banks got bailed out. So, Morgan Stanley and Goldman Sachs had to switch to a banking charter, and so with different capital requirements, like the whole thing was a giant disaster. So basically, the headline was all banks passed the stress test. I would reframe that to all banks passed a meaningless test that will bear no resemblance to any kind of real world stress that they may face in the next few years.
Yeah, Gary, with that, obviously it doesn't seem like there's much meaning to these tests. What is a fix, or is there a potential fix? I mean, how do we need to be holding these banks accountable? Who would even do that? What does a fix look like, or a solution?
So that's a really good question. That's the important question, and we should answer that instead of just complaining. And by the way, to give you a sense of how inaccurate these tests are, I read something over the weekend from Lax Ganapathy at Unicus Research. Lax is a friend of DKI. She's somebody I really respect. And she pointed out that because the banks passed these stress tests saying you have enough capital to operate, the banks were then allowed to operate with less capital and use that money for dividends and stock buybacks. Now, I'm not against dividends and stock buybacks. I think that's great. But the point is, they said your capital was up here, so you've passed. So now you can operate with your capital down here. Wait a minute. So the banks are operating with less security than they had to pass the stress test. This tells you how little the test actually matters. The test is a bunch of nonsense. Here's what I would do, right? I think, the answer is we're going to have bank failures and government bailouts as long as we keep operating this way. So raise your hand if you want to do another 2008 style bank bailout and have our money going to bail out the banks. Okay, I'm assuming that's nobody, but hey, if you're in favor of that, put it in the comments. I'm dying to see who you are writing that. The right answer, because we have low confidence in these tests, our solution is to inform the banks right now there will be no further bailouts. That's it. We tell them now. They just passed the stress test. They do not have stress. They just increased their dividends and buybacks. And we tell them, listen, you do what you want. You can take on additional risk. You can pay dividends. You can buy stock back, but your shareholders are taking that risk with you. And if your bank fails, all of the executives, you're all going to lose your jobs. Your pension funds, your stock options are all going to be worth zero. Your shareholders are going to be wiped out. It's all going to zero. The thing that we had where the banks get to have capitalism for their profits and socialism for their losses is a really bad idea. And look, I'm not the first person to come up with that idea, but I think it's a really good descriptor. And the reason it's a good descriptor is because people, every time this happens, people say capitalism has failed. Capitalism hasn't failed. We don't have capitalism when it comes to our financial system. We should, but we don't. And one of the great things about capitalism is failure. People who make dumb decisions, who take bad risks, go under. They go bankrupt. And their shareholders will go bankrupt with them, and their executives will lose their jobs. And if they don't want that to happen, then they should operate with a greater degree of safety, with more capital on the balance sheet, on the books. If they want to act like a hedge fund and leverage up and earn high returns, go for it. But somebody should tell them today, right now, you have capital, you are secure, you are safe, We're not bailing you out. If you do stupid things, you'll suffer for it. So that's what I would like to see happen. Now, this is a great idea. And yes, I'm saying my own idea is a great idea, which is why it will never happen. It's simply not, it's not going to happen. I get that it's all a pipe dream, but it would fix the problem.
Yep. Makes sense, Gary. And yeah, it's just an unfortunate situation where you have these standards, or at least this information that gets put out, the public reads it, everything's good, but in the background, you know that things are not great, and the situation can be quite dire, especially as we saw in 2008. Gary provides a great recommendation, but as we know, logic is not always the way things are done in these systems. Gary, we're going to wrap up with our educational topic. Before we do, please head over to deepknowledgeinvesting.com, grab a free subscription. You'll be added to our email list that will send out the 5 things in written version to you each week, as well as any other content that's being posted on the blog. Please note some of that content will be blocked due to premium access for our premium subscribers. That's $100 a month, and a subscription can be had on our website. Head over there. You can also use our Ask Gary feature, send in a question to the show, or if anything, please just follow along, leave us a comment if you disagree. Would love to hear that, start some conversation, and maybe even have some of those topics show up on the 5 things. To wrap up the fusion issue, Gary, the 5th thing, educational topic here. We're talking about how companies return capital to their investors. We're going to talk about dividends and buybacks, Gary, but why don't we just start with a high-level overview of how companies return capital to their investors, Gary?
All right, Rob. So obviously, when we invest in a company, we want to receive more money later, right? If you invest $100 today, we want more than that a year from now, or 5 years from now, or 10 years from now, whatever your investment time horizon is. There are basically 3 ways, there are dozens of ways, but there are 3 main ways that companies return capital to shareholders. One would be to take cash flow or earnings from company operations and invest them in more company operations, right? This is something that Amazon did for decades, right? Instead of giving the money they made, or didn't make rather, to shareholders, they built a bigger and bigger business. They built Amazon Web Services. They built out Amazon Prime Video. They built out more warehouses. They just made it a bigger, better business. Okay. And the company became much more valuable. Good for them. 2 other ways they can do that are returning capital to shareholders, either through dividends. A dividend is where the company actually writes you a check as a shareholder. Check your brokerage statement and you'll see that, dividend from company XYZ got paid, and there'll be more money in your account. You have cash. Great. And then the third way is something called the stock buyback, where what the company will do is they'll take that same money and they'll go into the open market, right? Just like you or I could go into the market and buy stock in any company today. They buy their own shares back and retire them. And the retiring them is the key thing. So I want you to imagine a scenario where, let's use a ridiculous example, a company with 10 shares outstanding, Rob. So you own 1 share, I own 1 share, and 8 other people each own 1 share. The company says, well, we've got some extra cash flow. We're going to buy back 1 share. And they go to, one of the other guys who owns it, and they buy that share and they retire it. Now, the company is out cash, but Rob, you and I, before, we owned 1 out of 10 shares. Now we own 1 out of 9 shares. Our percentage ownership in the company is increased by roughly 10%, right? Because 10% of the shares outstanding have now disappeared. They're gone forever. When people talk about a stock buyback being a one-time benefit, that is not correct. Those are people who do not understand the way this works. Those shares are retired. So, those are the 3 main ways. And the reason we're only today talking about dividends and stock buybacks is because a company that invests in its own operations trying to increase the value of the company, well, that one's kind of obvious and everybody understands that.
Gary, do you have any particular preference one way or the other, dividends, buybacks? Do you look for stocks particularly one way or the other? I know specific stocks paying out dividends. Pros, cons for you, or preference one way or the other?
I do, yeah. And not everybody's going to agree with me on this. I strongly prefer buybacks. So let's talk about why. And better yet, let's be fair on this. Let's talk about the advantages of dividends first, right? So with a dividend, you get a cash payment. That's great. And it's a recurring, predictable payment. Companies can change their dividends at any time, but generally what they do is they try to pay a consistent dividend. So imagine you have a company that says, okay, we are going to pay a dividend of 25 cents per share, typically per quarter, right? And what you'll see is that they get to the next quarter and that dividend will almost always then the next quarter be 25 cents and then 25 cents. And when they increase it, and they try to increase it, obviously there are situations where they lower it, they'll try to increase slowly over time. So the next year you may get 26 or 27 cents per quarter per share. And what that does is it makes your payments more predictable. The other advantage of dividends is there are a lot of mutual funds and ETFs where the managers are only allowed to own companies that pay dividends. So simply by paying any dividend, even if it's just 1 penny per share, what it does is it opens up your stock to a whole other class of potential shareholders, and it allows more people to buy your stock, which can increase your stock price. So those are good things about dividends. I'll tell you the reason I like buybacks. One is, and the key thing here is I'm assuming these are buybacks of a company where I like the stock price. The advantage of buybacks is it lets you determine the timing of realizing those gains. So let's go back to the hypothetical example we had just a few minutes ago, Rob, where we each own one share of a company. And because the company buys a share and retires it, our percentage ownership goes up by 10%. That should make the price of our stock go up. And what we can do is we can realize that by selling our stock, or we can wait and realize it later. And the advantage of realizing it later is we get to pick our tax timing. So, for example, if we wait more than a year, we go from short-term to long-term capital gains, which tend to be much lower. And you also, if you wanted, could pick your timing for a situation where maybe you have some tax losses in a given year, and so you could realize those gains and offset those tax losses and maybe not pay taxes. Now, for clarity, I am not a CPA. I am not a tax advisor. We are not giving tax advice. We're not qualified to give tax advice. This is a general way of understanding various things of how the stock market works. If you want tax advice, you should go seek the help of a qualified tax professional. I am not that person. I'm not qualified for that. Really just trying to give you a little background here. Now, the danger of buybacks is companies can harm themselves in two ways doing it. One, sometimes companies will buy back their shares when their stock is expensive, right? It may be at a level where I wouldn't buy it back. If they're buying their own stock back at a price that is more than the intrinsic value of the company, they're going to destroy value, and that's not a good thing. The other thing is there have been situations where companies have taken on debt and used that money to buy back stock, and so they're adding leverage. Now, if company operations go well and the stock market's strong, it's a great move. It can work extremely well, but you're leveraging up the balance sheet. You're taking on fixed liabilities, fixed payments to pay off that debt and reducing that cash flow. And you may end up having to do a secondary offering to save yourself at a lower stock price. Basically, when used well, buybacks are the best option, but they are more risky with management teams who at times have not used them wisely or taken on too much debt or paid too high a price for their stock. So it is more risky, but if it's a company that I like at a price that I like with a management team I trust, that's where you get, I think, the better return. And it gives you control of the kind of tax treatment you get. So that's why I prefer one. But for those of you who love dividends, great. We're not against you. I think dividends are terrific as well. I own actually a couple of pipeline MLPs, that stands for Master Limited Partnerships, simply because the dividend yield on these companies is like 7 or 8%. The dividend regularly grows. That's actually pretty good, right? To make 8% on your money and own a stock that's going up and a dividend that rises, I would rather own that than treasuries.
Yeah, no doubt. Great breakdown there, Gary. And that concludes our educational topic: how companies return capitals to investors, walking through dividends and buybacks. We'll have another educational topic for you on next week's show. This was the Fusion issue, this week's version of the 5 things to know in investing for the week. Hope you guys have a great week out there in the markets. Again, like, subscribe, shoot us a comment, DM, ask Gary on the website. And we'll be sure to see you next week, same time, same place, as we host this show on a weekly basis, giving you everything you need to know in investments and market research. Gary, turn it over to you for final closing thoughts.
Well, Rob, first, as usual, huge round of applause to DKI's interns. Cash and Crow and Samak Jain just do a fantastic job every week. They are far ahead of where I was in terms of finance knowledge at the same age. We just added a new intern from Dartmouth, Gideon Rodham. I think he's going to be a contributor very early. He's doing a great job so far. So the team's doing really well, and it's great to see these young people making such huge contributions. So much of what we were talking about today is based on work and research that they've done. So great job by our young team. Rob, I always want to thank you for doing this with me and the team at Flying V, all the resources you guys have put behind this. That's been amazing for me, having people like Jonathan and Alex deal with the written version, and people like Nazim and Anton contributing in a huge way on the video version. I just, really great to be doing this with you and the Flying V team, and you've just done so much for all of us. Most importantly, for those of you watching this, we know your time is valuable. Thank you so much for spending it with us. If you want to give us a like and subscribe, we'd appreciate it. But hey, we're not the boss, so you do whatever you want. We'll see you next week.
Thanks, everybody.